Radhika Merwin, and this is the big picture on monetary policy. In today's session, we will look at another tool that the RBI uses to tweak short-term rates and money supply in the economy. This is called open market operation or OMO. OMO is the buying and selling of government bonds by the RBI to control the liquidity in the system. By infusing additional liquidity or by sucking out excess liquidity, the RBI also indirectly controls the interest rates, inflation, and exchange rates in the economy. But before we understand how the OMO works, let us understand what is government security. Government securities include central government securities, treasury bills, and state development loans. These are issued to finance fiscal deficit and also manage temporary cash mismatches of the government. Registered entities in India like banks, financial institutions, mutual funds, foreign investors, and even retail investors are allowed to buy these bonds. But normally these bonds are purchased by banks and financial institutions. The reason why there is a ready market for government securities are various. Aside from providing a fixed rate of return, these bonds also offer the maximum safety. They are available in a wide range of maturity from 91 days to as long as 30 years. These bonds, unlike corporate bonds, are also highly liquid and are actively traded in the secondary market. Government securities are also used as collateral by the banks to borrow money from the RBI in the repo market, which we have seen in earlier session. So government securities are available in primary and secondary market. In the primary market, the RBI issues these bonds through an auction process. There are two types of auctions, competitive and non-competitive bidding. In a competitive bidding, investors bid a price or a coupon rate. But these are done by investors who are very well informed, like banks and financial institutions. Competitive bidding was introduced to allow retail investors also to participate in government securities because they are not well informed to participate in the auction process. Under this, a small amount was reserved for retail investors, and all they need is a gilt account with a bank or primary dealer. Now that we understand what a government security is, who buys and sells them, and why there are ready takers for these bonds, let us understand the RBI's open market operation. As mentioned earlier, the RBI controls the money supply in the economy through OMOs. How? When the liquidity in the system dries up, the RBI intervenes and buys government bonds. When the RBI buys government bonds, it infuses liquidity into the system. On the other hand, when it wants to suck out excess liquidity, the RBI sells government bonds. Before the financial reforms of 1991, the cash reserve ratio and the statutory liquidity ratio were primary tools used by the RBI to control the liquidity in the system. But soon these tools lost their importance and OMOs became more effective in controlling the liquidity. But aside from managing the liquidity, these tools also help the RBI to control the inflation, exchange rate, and also manage the interest rates. For instance, when the RBI buys government bonds and it infuses liquidity into the system, this leads to interest rate softening. Hence, governments and corporates are able to borrow funds at a cheaper rate. This also prevents a steep appreciation in the rupee, and it increases inflation. When the RBI sells government bonds to suck out excess liquidity, it achieves just the opposite. Increases interest rates, lowers inflation, and curbs the fall in rupee. One of the main challenges of any central bank is to assess the liquidity situation in the system and decide on the quantum of OMO to be done from time to time. One of the concerns of late in India has been the large financing of fiscal deficit through market borrowings. Thus, ideally, OMOs should be detached from fiscal operations and solely linked to the purpose of liquidity management.